Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're going to be going back to the basics and talking about selling covered calls, how to generate income selling covered calls. This will be going over the strategy itself, and we'll go through some variations of the strategy as well so that you understand different ways that you can generate income selling cover calls, whether that's through monthly options, weekly options, what the benefits and pros and cons of are each one, and just the general mechanics of how to find opportunities using this specific strategy to help you generate consistent income in your portfolio. Now, before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So my goal is pretty simple. I want to help you understand a simple strategy to help you generate weekly or monthly income using options. So we're going to go over simple rules, meaning how to generate a consistent income stream, using clear rules as to when to enter a trade and when which options specifically to sell, and then talking a little bit about passive management, how you can trade these types of strategies without necessarily having to look at your portfolio every single day, managing these positions once a week, or potentially holding them through expiration, how to manage these in a way that's relatively passive. So that's kind of what my goals are for today. Now, who's this webinar for? Now, if you think about options trading, a lot of options trades are relatively speculative in nature. And what that means is that, most portfolios, allocate the vast majority of your wealth or your account to longer term equity investments, longer term investments, and then you have a relatively smaller portion of your account that you are trading more actively, that's more speculative in nature. And traditionally, when we talk about options trading, we're talking about the segment of your portfolio that's highlighted in green, the more active speculative portion of your portfolio. But what we're going to discuss here today is actually the blue part of your portfolio, the larger part of your portfolio that's focused on longer term investments. Securities in your portfolio that can generate consistent yield in your portfolio that require a few rules to achieve that consistent income stream. Because most of the time when you think about options, you're not thinking about your long-term investments. But today, what we're going to do is we're going to discuss how you can generate income on those long-term investments utilizing options in a consistent manner, where every single month you're looking for yields on that long-term investment portfolio. So in order to do that, we are going to look at a strategy called a covered call. Now, many of you that have traded options before, you might be familiar with a covered call, but for those of you that are brand new or getting starting out with these types of strategies or starting out with options, just a quick review of what a covered call is. A covered call is essentially a strategy where you take 100 shares of a stock or ETF that you currently own. Whether it's Apple stock or SPY or QQQ, any stock or ETF that is optionable that you own at least 100 shares of, you can sell a call option against that stock or ETF and use that stock or ETF as collateral. So let's just understand that separately. When you sell a call option, you create an obligation to sell the stock or ETF at a specific price. So think of it like almost like a limit order, right? When you place a limit order to sell the stock at a specific price, you're obligating yourself to sell that stock or ETF at a specific price. Now, if you were to just sell a call option, you are effectively taking on the obligation to sell the stock at a specific price. Now, the reason that you can do this using a long-term, positions that you have in your portfolio is because you can essentially use those positions as collateral against that obligation. If you already own the stock, then you can take the obligation on to sell the stock at a specific price because you own the stock and you can use that stock as collateral for the delivery if the call option is called upon you. So we're going to go through some real examples to help you better understand this particular concept. So let's say you own 100 shares of a KRE. at $40 a share, and you have a price target of $60 on that, right? And let's say in this particular example, the stock is currently trading at $52.78. So you bought the stock at this is technically an ETF, but let's say you bought the ETF at $40. It's currently trading at $52.78, and you have a price target of $60 on this ETF. So as an equity investor, if you own this the ETF at 40 and your price target is 60 on it, you would look at selling the stock with a limit order, right? So you would basically enter a sell order for KRE at $60 a share. So your total risk on the trade would be what you paid for the ETF, which is $40 per share, or $4,000 for every 100 shares. And your potential reward on this is $2,000, the difference between your price target, your price target and the price that you own it at, which is $20 or $2,000 for the 100 shares that you own, right? So if you're an equity investor, I think this is an outcome that you're probably familiar with and understand. So let's now take a look at what if you have the exact same scenario, but you are an options investor. And this is really where you can look at, instead of selling the stock with a limit order, you can look at selling the stock, with a covered call. And what that means is that instead of placing a limit order to sell the stock at $60 using a sell limit order, what you do is you sell a $60 call option for KRE stock. And the difference between a limit order and selling a covered call is that when you sell a call option, you get paid premium for selling that cover call. In this particular example, let's say you collect $1 for selling that $60 call option. Now, when you sell a $60 call option, you take on the obligation of selling the stock at $60 if on or before the expiration, if at expiration the stock is trading above $60. So just like a limit order, if the stock trading above the limit order price, you're obligated to sell the stock. You have the same obligation when you sell a cover call, and you're specifying what strike price or what price you want the obligation for selling the stock. But the difference is that with a cover call, you're getting paid premium. In this particular case, you're getting paid $1 to take on that obligation. So when you get paid $1 to take on this obligation, as you can see, what it immediately does is it reduces your overall risk on your initial equity investment, right? Instead of risking $40 a share, you're now only risking $39 a share because you've collected $1 in income. So that reduces your total risk on the trade from $4,000 down to $3,900. And on the flip side, if the trade does reach the $60 price target, your maximum reward on this trade now is increased to $21 per share, or $2,100 for the 100 shares. So what it does is it starts to increase, or rather increase your potential reward, decrease your risk, so giving you a more favorable risk to reward ratio on your equity investment. And let's say a month later, the stock is still trading around $52.78. It has not reached your price target yet. Well, when you have a limit order, you have to just simply sit and wait for that limit order to potentially rise up to your price target. But when you sell a covered call, once that call option expires, and let's say that option expires worthless because the stock hasn't reached the $60, it hasn't reached the $60 price target, well, you can sell another $60 call option for another $1 and collect another $100 in income, and further, increase your risk to reward ratio in your favor. So this is all going to help you better your equity outcome every single time you sell a covered call. So this is designed to really help you better your equity investments every single time you sell the covered call, and you can do this over and over again every single month until you get the stock reaches your price target, and you are able to you're able to sell your stock at the price target that you have. So let's look at kind of um, now that we better understand the strategy, what I want to now help you better understand is if you're thinking about selling a cover call on a specific stock, how do you decide what cover to sell? So when you're thinking about selling cover calls, generally speaking, when you're selling any type of options, you have to select a expiration date and you have to select a strike price. So what we're going to look at here is helping you understand how to select the optimal strike price and how to select the optimal expiration date. So when we look at selling cover calls, we've done a lot of back testing on this specific strategy, looking at what is the optimal expiration date and the optimal strike price. So based on our research, we have found that the optimal expiration date to use for selling a cover call is going out roughly 45 days from expiration. And what that allows you to do is to basically have a fair amount of time decay that works in your favor because options decay as you approach expiration. So the shorter dated expirations actually give you more favorable decay. However, the shorter dated options also have what we call accelerated risk. So what we're trying to find is a right balance between an acceleration in that time decay, that's working in your favor, but also what we don't want is options that are too close to expiration where there's added risk to it. So the optimal expiration that we tend to find is roughly 45 days out. Now, when it comes to strike prices, this is really where everyone kind of has their own different opinion. And I want to kind of review this to help you better understand what the right strike price is. Because if the stock's currently trading at around $52.78, you have multiple choices, right? You can sell a $56 call option, you can sell a $58 call option, you can sell a $60 call option. And what I have here is just a few different choices to help you understand kind of what the spectrum looks like. So let's say you sell a $56 call option. That's going to collect $1.50. That has what we call a 30 delta. That's a 30% chance the stock will be above $56 in 45 days. If you sell the $58 call option, that's going to collect $1.25. That's a 20 delta, 20% chance the stock will be above 58. And then if you sell the $60 call option, that's going to collect $1. That's a 10 delta. There's a 10% chance the stock will be above $60 in 45 days. And what you have here on the right is the yield information, how much yield you're going to collect over the 45 days. When you annualize that yield, this is how much yield you're going to collect: $1.50 on the $52 stock versus $1 on the $52 stock will yield you anywhere from 14% to 26%. And this is really where a lot of investors will look at this and say, well, if I'm selling options, which strike price should I choose? And naturally, most traders will gravitate towards strike prices that collect more yield. And I think that's pretty obvious as to why they might gravitate towards a strike price that collects more yield. However, based on our research, if you look at kind of the long term, which strategy gives you the best outcome in the long run, it's actually the ones with lower yield. And that doesn't really make a lot of sense for a lot of users. However, if you look at the difference between how much you're collecting, $56 for $1.50 or $60 for $1, the difference between these two numbers is only 50 cents, right? So in the 56 strike price, you're collecting $1.50 versus $1. That means you're collecting an extra 50 cents in income. However, what you're giving up in this particular case is $4 in upside. Meaning, if let's say the stock, over the next month or so really takes off, right? If you sold a 56 strike cover call, you're selling your stock at 56, meaning no matter what happens, even if the stock goes up to 100, you're not participating in it because you sold your stock at 56. Versus if you sold a $60 strike price, Then if the stock reaches 100, you've sold your stock at 60. So what you're doing here is you're basically giving up $4 in upside in exchange for 50 cents today. And that is a outcome that's going to be suboptimal for you in the long run. Meaning, what you should always optimize for is, generally speaking, a strike price that gives you as much upside in your underlying position as possible in exchange for perhaps, 50 cents, 75 cents less income up front. But when the stock does take off, and from time to time, a stock just takes off, maybe they have good earnings, they have a good month from, the market does really well, and what you want to do is you want to make sure that you participate when that stock does really well. If you always sell your stock at a lower price, in exchange for an extra 50 cents or an extra dollar in income, you're going to underperform in the long run. So that's a really important concept to understand when you're selling cover calls: is don't chase yields. Yield is going to look attractive on paper in the short run, but it's going to yield you worse results in the long run. And that's a really, really important concept to understand when you're selling cover calls, is that you want to prioritize the upside of the underlying position that you have versus prioritizing short-term income. Okay. So the other thing to think about here is the expirations, and we talked about this a little bit, but kind of to help you better understand. There's, when you're trading options, there's the Greek theta, and that's to help you understand the change in the value of options with respect to time. Meaning, how much does the option value decay with respect to time? So the extrinsic value of an option decays faster and faster as you get closer to expiration. So technically speaking, what you are going to do is, if you sell 4 weekly options, meaning if you sell an option that expires in 1 week's time and do it 4 times over and over again throughout the month, you are technically going to collect more income than if you sold 1 monthly option. However, the problem is that when you're selling shorter dated options, you're getting less income per trade. And every single time you sell a cover call, because you're doing it 4 times in a row, you have the risk that the stock gets called away, in week 2, right? So what that means is that if, let's say, the stock gets called away in week 2, you're going to collect less income in 2 weeks than you are going to collect in 1 month if you sold a monthly option. In addition to that, you also have higher transaction costs when you're selling shorter dated options. So one is not better than the other, but it's important to understand that the more frequent you sell, the more likelihood that you're actually going to collect less income overall on the trade, because you have just more opportunities for the stock to be called away where you're not collecting more income, and you're adding higher transaction costs to your trade. So from that perspective, we tend to find that the sweet spot is roughly 30 to 45 days out, where you're going to collect a fair amount of time decay, but you're not having that added transaction cost, added frequency of that exercise risk on the overall trade. Okay. So let's talk a little bit about, in this particular example, you sold the 52, the stock's trading at 52, you sold the $60 call option. How do you think about managing this? So generally, there's 3 things that will happen, right? If the stock rallies above $60, well, now your ETF is going to get called away. So you're going to make a profit of $2,100 on the trade. You're going to miss out on further upside. So let's say the stock reaches, I don't know, $70, right? You've missed out on any gains above $60, but you have the potential to sell puts to acquire more shares. Because you've sold your stock at a profit, you can now take that profit and basically sell put options to potentially now acquire more shares if you still believe in this underlying stock. Now, if, let's say, the stock stays below $60 at the expiration of your call option, now you own your stock at a lower net price, right? Because you've collected income on the cover call. You've yielded 1.64 of the stock's value in 45 days, and now you have the potential to sell another call for further income. So what you can do is you can sell a cover call and wait until expiration, because one of two things is going to happen at expiration. Either the stock is above your strike price or it's below your strike price. And what this means is that this is a strategy that can be fairly passive. You've sold the cover call, and you basically hold the cover call until it expires. And at expiration, one of two things can happen, and you basically make your decisions, or rather, your outcome is already determined for you based on where the price is at expiration, and based on that outcome, you can decide what you want to do next. Okay, so this is a strategy that can be done fairly passively. It's not the type of strategy like other option strategies where once you get into it, you got to monitor the trade every single day. With these types of strategies, it is anyone with level one options can trade them, and it is relatively simple, both on the order entry as well as the management of these types of strategies as well. So the probably the most important thing that I wanted to show you here is access to the cover call screener that we have here at Options Play, which is available to you through your First Trade account. So when you go to your First Trade account, first of all, you can access it either by clicking on the Options Wizard button here on your home screen, or you can go to Research and Tools and go to Options to be able to access the Options Play tool. You can also access it through your quote bar. There's quite a few different ways that you can access it. So I'll click on the Options Wizard button here to show you the Options Play tool. But what we have here is a way for you to screen for cover call opportunities, meaning what stocks generate high amounts of yield selling cover calls. So under the Ideas section of your First Trade account, you will see a drop-down menu. We have technical trade ideas, cover call ideas, credit spread ideas, and short put ideas. So for today, we're going to look at cover call ideas. And what it does is it basically sorts through all liquid optionable symbols. As you can see, there are 552 symbols that we consider as liquid from an options trading perspective. And what we've done is we've basically looked at the optimal cover call across every single 552 stocks and sorted for you based on where you're going to generate the most yield. And you can basically scroll down this list until you see a stock that you own in your portfolio. So let's say you own Snapchat in your portfolio, right? So what you can do is you can click on the Snapchat trade, and what it'll do is it'll bring up, exactly which cover call to sell. So this is looking at selling the November 29th $15 cover call. So as you can see, what we've automatically selected for you is a call option that expires in roughly 45 days. And we've selected a strike price that has a probability of expiring worthless of about 90%. If you remember in the example that I showed you here in KRE, right, we showed you that the optimal cover call here is the $60 strike price. We chose that because it has a 10 delta. There's a 10% chance that the stock will be above $60 at expiration. Or you can translate that as that there's a 90% chance that the stock will be below $60, right? 90% chance. That's why we chose the $60 strike price. So this basically tool does all of the work for you. It selects the November 29th $15 call options, $15 cover call, because the $15 cover call is 45 days from expiration and has a roughly 90% chance that the stock will be below $15 in expiration. So, and what this does is it generates 3% yield in 45 days. And that annualizes out to about 28%, right? So the goal here is to help you find stocks that generate the most amount of yield in your portfolio, for stocks in your portfolio, and help you understand where you're going to be able to generate the most income using this strategy. So you can basically just go down this list, find stocks that you own in your portfolio, and that as you go down the list, these, the ones at the top of the list are the ones that generate the most yield. So let's say you owned, Lyft in your portfolio, right? Let's say you own 100 shares of Lyft. So looking at Lyft here, what it does, as soon as you click on it, we are finding you the optimal cover call. So here The November 29th, 17 and a half call option expires in 44 days, has an 88% probability of expiring worthless, and you're going to collect 2.22% in yield in 44 days. That's not 2.22% per year. That's 2.22% in 44 days. Annualize that out, that's nearly 20%. Annualized return, as you can see, 19.98%. That's how much yield you're going to be able to generate if you were to do this continuously throughout the year. So as you can see, there's a fair amount of yield selling, what I would consider, a lot of people consider a really boring strategy, a cover call. A lot of people call it a boring strategy, but 20% yield is not boring in my opinion. And you're basically giving yourself the ability to kind of remain invested in this particular stock, but at the same time, effectively getting a significant amount of downside protection in this stock for free. You're not paying for this downside protection. You're getting paid income by taking on the obligation to sell the stock at a specific price in the future, right? This is a $13 stock. If you sold the stock at $17.50, that's a really nice return, right? On your stock position. You're talking about a nearly 20% gain in the stock in 45 days. If someone told you you can buy a stock and make a 20% return in the next 45 days, you'd probably be a pretty happy camper that a stock that you bought rose 20% in 45 days. And that's what would need to happen in order for your stock to get called away. So getting your stock called away when you're selling cover calls using this type of strategy is, generally speaking, a pretty good result, right? The stock has made a pretty big move in a short amount of time, so you've gained that. You've had a nice capital gain on the underlying stock position, and you've generated in the meantime roughly 20% yield for just owning the stock that you already have in your portfolio. So if you didn't do this, you would basically lose out on 2.22% of the stock's value over the next 45 days if you didn't do it. And the only thing that you're giving up in exchange for that is if the stock exceeds 17 and a half in the next 45 days, you're giving upside above that, right? So the reason that we're choosing these strike prices that are really far away is because, if the stock, reaches $18.50 by expiration, you've captured the vast majority of that gain. And it really would take a pretty sizable move in order for that to happen. And generally speaking, what we're doing is we're helping pick strike prices that are so far away that if it does get called away, you're generally a pretty happy camper because the stock has made a big move in a short amount of time. Okay, so this tool is designed to help make this whole process for trading these types of strategies as easy as possible by simply doing all the scanning for you. So you just simply go down the list, look for stocks that you own. So let's say you own United Airlines, right? You click on that stock, it's up 11% today already. Let's say this is telling you to sell the $80 cover call that expires on November 29th. 44 days is an 80% probability of expiring worthless. You're going to generate another 1.87% over the next 45 days with United Airlines. So you can basically go down this list and very, very quickly, within a few minutes, know if there are opportunities to sell covered calls on the stocks that you own. And without having to pull up an options chain to figure out what expiration date and what strike price, it gives all of that to you, gives you the yield information, and you can just simply click on the trade button, preview order, and you can place this trade within your first trade account. So this is all designed to help you find your opportunities extremely quickly, give you all of the information that you need at your fingertips without having to do any calculations, explains the strategy to you in plain English here. So if you're brand new, it kind of gives you a good outlay of what you're doing, what the risks you're taking on, and what obligations you have, and what the metrics are for each strategy so that you understand before you execute that trade. Okay? So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you that kind of quick overview of like how do you generate income in your portfolio with a simple strategy with the cover call, what are the mechanics for doing so, and tools that you have available to you at First Trade that help you implement this specific strategy. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, feel free to, there's a Q&A window here. Type your questions in the Q&A window and I'll try to answer all of your questions before I sign off here today. If we want to sell cover puts on a stock we own, is it just a reverse technique of selling cover calls? I'm not sure what a covered put is. There really isn't a covered put because, um, unless you're short the stock and you're trying to use that as a strategy to buy back short stock, but I don't think that that's what you mean, William. So if you don't mind clarifying, let me know. How do you get the recording? So you can find the recording on firsttrade.com under, I think it's education resources. You'll see the recordings there. I've experienced having my cover calls being called away a few days before expiration. I would have rather closed it out. Is there any way to ensure that a cover call position could be held to expiration so that I close it out then? So Christine, generally speaking, if the stock is below your strike price, the risk of the stock being called away before expiration is relatively low. Um, if your stock price is above, if the stock is above your strike price, then you do have a higher risk of the stock being called away before expiration. The other thing is that if the stock has a dividend coming up, there's a higher chance that you will have that stock be called away early. So those are the things to look at for, dividend is probably the biggest culprit of when a stock could get called away prior to expiration. If the price doesn't reach the strike price, what is your loss? There is no loss. You keep 100% of the premium that you collect on the cover call, right? The only loss that you have is if the stock drops in value, right? So your underlying position has a loss if the stock drops in position, but you don't lose anything on the cover call. What you collect on the cover call, you keep 100% of it. So, for example, in this example, right, let's say when the stock's trading at 52, I sold the $60 call option for $1. And a month later, the stock's still at 52. I basically walk away with $1 per share. So $100 per contract. A cash covered put would be sort of like a covered call. Yes, a covered call and a cash secured put have the exact same risk profile. Um, If you believe the stock was going to go up, can you sell a put on it? If you believe the stock was going to go up, can you sell a put on it? So you can always sell a put option, but that has nothing to do with owning the stock or a cover call. You can always sell a put option on stocks that you think are going to go up. That's a completely separate strategy. We're actually going to cover that here in 2 weeks' time. So the next session that we're going to be hosting is going to be on selling cash secured puts. So William, if that's your question, we'll be covering that on the next session. Any other questions? Does this affect the cost basis of a stock holding? It doesn't affect the actual cost basis from a tax lot perspective, but it does affect the net cost basis because, for the more income you bring in, the lower your net cost basis is, but it doesn't affect it from a tax lot basis. Any other questions? Also, these recordings will be hosted on the First Trade YouTube channel, so you can always subscribe to the First Trade YouTube channel if you want to have access to these recordings. Does options play look at before it recommends a specific stock and option? So everything is calculated in real time, right? So when you click on that strategy, when you click on that symbol in options play, right, we are basically pulling chains in real time and giving you kind of the most up-to-date information. So everything is done in real time. Any other questions? If there are no other questions, I just want to thank everyone for your time this afternoon. I hope that this is helpful in giving you a review of this very simple strategy and, more importantly, how you can leverage the tools that are available to you here at First Trade to execute them and find these strategies for your portfolio. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.